Assalamualaikum. Welcome to lecture 2 of financial reporting. Today's topic is conceptual framework. So in lecture 1, I have gone through the regulatory environment, how IFRS are set, what is the duty of the IASB and the ISSB, and we have talked about conceptual framework in lecture 1. Now we are going to go in detail of the conceptual framework because you need the understanding of conceptual framework to recognize or measure the 5 elements in the financial statement, specifically if you're not having a relevant IFRS. Okay, so in this lecture we are going to go through the purpose and the status of conceptual framework. Okay, remember conceptual framework is a principle based. Okay, so we are going to compare this with a rule based. Then the status of conceptual framework, the financial statements, users and their information needs. Then general purpose financial reporting, what are the objectives, what are the limitations, accrual accounting, because we are going to prepare our accounts based on accrual accounting. Then the underlying assumption of going concern. Whenever we prepare financial statements, we assume entity will continue forever. Okay, unless condition exists that says that you have to wind up or liquidate your company. But the situations are not very common. Okay, mostly it is going concern assumption. Then qualitative characteristics. And information should have this qualitative characteristics for it to be useful. We are going to go through the fundamental characteristics and the enhancing characteristics. There are 2 fundamental and 4 enhancing. We have touched upon this characteristics in my previous lecture, that is lecture 1. And here we are going to discuss once again. And the cost constraint. Then the elements of financial statement. This is the important area. So you have to know the terminology, the terms. How do we recognize, derecognize, the measurement basis, then the accounting basis, that is historical cost accounting or current value. So 2 accounting is there. One is historical cost, one is current value. And we are going to go through the fair value. So one standard we are going to cover here, that is fair value, which comes under your IFRS 13. Okay, what is the meaning of fair value? How do we find the fair value of non-financial asset? Then the price, hierarchy of inputs that we need to to find the fair value. How do we disclose? And finally, we are going to see which part of the syllabus we have covered from this lecture and summarize the entire lecture. And are there any technical articles you have to read for this lecture? That is conceptual framework. We'll see. So this is what I've explained till now. We start with the purpose and we go to general purpose financial reporting, and then we look at the qualitative characteristics, we look at the elements, then we look at the accounting basis, and finally the fair value, because elements of the financial statements we have to measure using fair value, most of them. Okay, most of the standard, if you see IFRS standard, they will require you to measure at fair value. Now the purpose. So a conceptual framework, they lay the foundation for accounting standards. Okay, and they provide the scaffolding within which they are developed. Your accounting principles that are based, okay, that are laid down, are the foundation is what conceptual framework. It all started from the conceptual framework. In the conceptual framework, it is given what is the definition of an asset, what is the definition of a liability, income, expense, equity. Based on that, they have made accounting standards for various element. Okay, so the purpose of IFRS conceptual framework for financial reporting, or short conceptual framework, is it helps the IASB. What is IASB? Please go back to my lecture 1. The link of lecture 1 will be given at the end of this video. So you can see I have explained what is the role and the duty of the IASB in my previous lecture. So they help to develop IFRS accounting standard. So conceptual framework helps the IASB to develop the IFRS accounting standards. Next, it helps the preparers of the financial statements to develop consistent accounting policies. The accounting policies that you apply, how do you do it? You rely on your conceptual framework. Okay, and also when no standard applies, or when a standard gives you a choice, we always look at a conceptual framework. And the third It helps all the parties to understand and interpret the standard. If you fail to understand the standard, go back to the definition of conceptual framework. What does it say about the asset, income, equity, expenses? And you will understand the definition of the standard better. You understand? So these are the three main purpose of conceptual framework. It helps IESB, it helps the preparers, and it helps all the parties. Now the purpose. So the current version of the conceptual framework used to develop and amend the IFRS accounting standards was issued in 2018. 2018, it is the latest version of conceptual framework, because after 2018 they did not develop any more version of the conceptual framework, but maybe in future they might. Earlier there was 2015 conceptual framework, and then 2018. This is the latest. Okay, so if you see most IFRS standard that are currently in issue, that you are going to study later on in this financial reporting, are developed in line with your version of earlier conceptual framework, that is 2015 conceptual framework, not this. So that's why you will often see that requirement of the conceptual framework and the requirement of the standard do not align together. There's a difference you will see. Okay, now a conceptual framework. So now principle versus rule. A conceptual framework basically lays down the principles within which accounting standards are developed and transactions accounted for. In some gaps, principles that can be applied to all transactions are well established, and instead accounting rules are developed. See, some gaps you will see principles are not very effective, because principles is very difficult to apply to all transactions. Rather, they have developed accounting rules that applies to specific transactions under some gap. One example is US GAAP. US GAAP is a rule based. Okay, that means for every transaction there's a rule. If there is no rule for that particular transaction, they will come up with a new rule. And most other gaps, if you see, they follow the rule of conceptual framework. They are principle based. So UK GAAP, IFRS conceptual framework, these are principle based. Okay, now under the principle based, there are no strict rules. It's just they are giving you guidance on how to prepare and understand financial statements. Okay, and a conceptual framework is a new concept in accounting. Why? Because before the conceptual framework, there was nothing that binds the entire system of financial reporting. They can prepare their reports in any way they want. But after conceptual framework came, everyone is bound to follow a uniform system. Okay. So without a conceptual framework, there were inconsistencies in the accounting practices. And that's why it made it very difficult for entities to make comparison among themselves and also among the different years. So the alternative to conceptual is set of rules. But the problem with the rule is people will often want to play with the rules known as creative accounting. Okay. Next. Even though consistencies might be improved, okay, we might say rule is good, rule based is better than principle, because by having a rigid set of rules, it is more consistent. But it is often a headache and it's more costly than principle based, because for every new transaction a new rule is required. And also that new rule might come in conflict with the existing rule for a similar transaction. Okay, but using a conceptual framework, it gives you a degree of flexibility and interpretation by the user, but ensures that the user stays within the bounds of conceptual framework. IASB's framework defines the elements of the financial statements and characteristics that should be embodied in those financial statements. Now, the status. Remember, conceptual framework is not a standard. So nothing in the conceptual framework can ever override any requirement in a standard. What does it mean? It means whenever you are in a conflict with the definition of conceptual framework and and the standard, always follow the standard. What the standard says. For example, an asset. Based on the conceptual framework's definition, you are not supposed to recognize the asset. But based on that particular standard, let's say IS 16, for example, or IS 38, intangible asset, you are supposed to recognize the asset. Then you are supposed to recognize the asset because the standard says so. You understand? Conceptual framework is a helping hand. That's the status of the conceptual framework is after the standard. If you have a particular standard, for example, to recognize sales revenue from contract with customers, we have IFRS 15. So we will follow IFRS 15 whenever we have certain contract with the customer to recognize revenue. We will not go by conceptual framework definition. But if we don't have for a transaction a particular standard, then we'll take the help of the conceptual framework. So conceptual framework is like a helping hand when standard is not giving you a particular answer. That is the status of conceptual framework. Now, these are the set of financial statements that you have to go through. Statement of financial position, also known as balance sheet. Statement of financial performance, also known as your profit and loss account. Statement of changes in equity, then statement of cash flows. Integral notes, statements, explanatory material. Remember, in your set of financial statements, the notes also comes, okay? Do not ignore the notes. These three are not your financial statements. Number one, reports by directors. Yes, you might want to read it to get a better understanding of the environment of the company, but they are not in the set of financial statements. Next, statements by chairman and any discussions or analysis done by management and similar items that are included in financial or annual report. They are not financial statements. Now, see, basically we prepare financial statements for our investors or lenders, right? But there are other various users who might get great benefit by these financial statements. So we are going to list the users on one side and what is their informational needs. The informational needs of each user is different. First, investors. For investors, they might want to see they are seeing the financial statements to know what is the risk and the return on their investment. So for this, because if they know this, then they can decide whether they want to buy the shares, hold the shares, or sell the shares. Next, this will help their ability to pay dividend. Based on this, they can see, are they in a position to pay dividend? Are the company having enough profit? Next, employees. For employees, they might want to see how stable the organization is, because if the organization is stable and profitable, then only they can get their salaries. Okay, so they will see whether the company is in a position to give them remuneration, retirement benefits, employment opportunities. Next, lenders. For them, their sole need is whether the company can loan, okay, can they repay the loan and the interest. Suppliers, whether you can pay them the amount that is due. Okay, customer, they want to see continuance because they're dependent on the entity. For example, if they are purchasing, they are your loyal customer, they might want this information even more. Next, governments, they want it to decide how they have to allocate their resource, and also for tax purpose, because they regulate activities in the economy through tax. Public, they contribute to the local economy. Okay, they are the ones who will give you the employees. So you have to take care of the public as well. And also they want to see the trend and the recent development in the prosperity and the range of activity that the organization is providing. Next, we are moving on to the general purpose financial reporting. So now we have understood the purpose and status of conceptual framework. Now we can move on to general purpose financial reporting. So general purpose financial reporting, as I told you in lecture 1, it is a report. It is same for all the user. You can't customize it for one particular set of user and it is different for the other. No, there is no customized, there is no tailor-made. It is same information for everyone. So general purpose financial information reports gives financial information to the investor, lender, and other creditor. See, this investor, lender, and other creditor, they are known as primary users. Of course, there are so many other users, customers, suppliers, but these three are the primary users. Lender, creditor, and investor. From them, you are getting the capital that you need. You are getting your funds from these people. So their need is greater. That's why they are known as primary user. Okay. So this information will help them to make decisions on how to, in relating to providing resources to the entity. So primary users mostly rely on this published financial information. Okay. So decisions will depend on this primary users' expectations about their return, which depend on their assessment of. So they will see the amount, the timing, the uncertainty of future cash flow, and the management's stewardship of economic resources. Through this information, they can see whether managers are taking care of their resources and also the amount, the forecast of cash flow. Users need information about assets, number one, liabilities. Next, how efficiently and effectively the entity's management and the governing board have discharged their responsibilities to use the entity's economic resources. Okay. Now, this picture, go through this picture. This will help you to understand the three set of financial statements and what information you can get from each. So first one is financial position. Financial position is affected by economic resource and claim. In other words, economic resource means your asset and claims means your liabilities. Okay. Then the financial structure. See, the financial structure is based on your debt equity. That is again your liability and equity. Then your liquidity and solvency. So from your financial position, you can see your financial structure. You can see how solvent you are and also your capacity to adapt to changes. So the financial position, this is known as statement of financial position. Next is your financial performance. This will give you the profitability. So you can predict the capacity to generate cash flow from your existing resource, that is from your operating activity. And also you can make judgments about effectiveness in using additional resources. This you will get from your statement of profit and loss and other comprehensive income. Next is changes in the financial position. So this you can use to evaluate your investing, financing and operating activity and the ability to generate cash inflow. This you will get from your statement of cash flow. So these are the three financial statements, the three most important. Now, the limitations of general purpose financial reporting. Number one, they cannot meet all the information need of primary user. Okay, that's why when you're looking the information only from the general purpose financial reporting, you will not get the full picture. You have to see the other sources of information. For example, economic condition, you have to see the political event and the industry outlooks. Next, IFRS accounting standards are developed to meet the information requirement of the primary user. Although other users may find them useful, such financial reports do not specifically aim to meet their needs. Mostly, they are targeting on the primary user, that is lender, creditor, and investor. The other users, customer, supplier, they are not going to get much benefit out of this financial report. Third, general purpose report do not show the value of the reporting entity because there are so many judgments that are made while preparing their financial statements. That's why you can't ever know the true value of that reporting entity based on that financial report. Next, as I so it is building on the third point, general purpose financial reports, they are based on estimates, judgments, and models. Now, accrual accounting. So we have moved to accrual accounting. Your financial reporting is based on accrual accounting because it gives a better basis of assessing your performance than cash receipt and payment. So under accrual accounting, this is how the effects of transactions and other events are. You recognized when they occur, not when you are receiving the cash or paying the cash. And you will record them in your accounting records and report them in the financial statements of the period they relate to. You can pay the cash or receive the cash later also, doesn't matter. But if it relates to this period, you will record in this period, no matter when you are receiving or paying the cash. Next, financial statements that are prepared on accrual basis will inform the users of obligation to pay the cash in the future and resources that represent cash to be received. See, because you're preparing an accrual basis, so through that financial statements, you will know what is your liability, what is your asset, how much you are going to receive, how much you have to pay. That obligation will be there. But if it was cash basis, assume you are preparing financial statement based on cash basis. Then there is no liability, no prepayment, no nothing. Whatever you are receiving, you are recording what you are paying. So that obligation you don't have to record. Asset liability will not arise. But now asset liability is arising. Asset is your receivable, liability is your payable. Because you are preparing on accrual basis. Even in the expenses also, you have prepayment and accrued expenses. Understand? So the accrual basis is giving rise to the matching concept. Expenses are recognized based on the direct association between the cost incurred and earning of income. So when are you getting that cost incurred? When are you earning the income? On that period, you will recognize the expense also. You're matching the expense with the income. So the accrual basis of accounting is also referred to in IAS 8. That is the basis of preparation of financial statements, which we'll cover in lecture 4. Now, the underlying assumption of going concern. There is only one assumption that underlines the preparation of financial statements. We always prepare financial statements assuming entity will continue forever, also known as going concern. So the going concern assumes entity will continue for foreseeable future. This basis is presumed to apply. It will apply unless users of the financial statements are told otherwise. So if there is an issue with the going concern, there is a doubt over the going concern, then you will write it in the notes to the financial statement. So therefore, if you are not having any intention to enter into liquidation or cease trading, it's a going concern. Because we do not always assume that we are going to liquidate or cease trading. It's not very common scenario. For example, today you started the business, tomorrow you will not cease it down. Okay. Now, going concern will also be referred in your lecture 4 under IAS 8. Now, third part is qualitative characteristics of useful information. See, you are giving information through your financial statements, right? But are the information actually useful? There should be some characteristics that makes this information useful. They are known as qualitative characteristics because they are qualitative in nature. You can't actually measure them. They're not quantitative. And there are total 6 characteristics. 2 of them are fundamental, has to be there, and the other 4, they are enhancing. It enhances the value of the information. First, fundamental characteristics is relevance. Information that you are giving has to be relevant. If it's not relevant, do not provide that information, and it should faithfully represent. We'll go through detail what relevance and faithful representation means. Then enhancing characteristics are 4. Number 1, you should be able to compare within different time period and among companies. So comparability. Next, verifiability. The information that you are given should be verifiable. Next, timeliness. It has to be prepared within the time. If you are giving an outdated information, it's of no value. Next, understandability. User should understand the information given. Now, for information to be useful, it has to be relevant and present faithful representation of resource, claims, transactions, and events. Now, relevance. What relevance means? Relevance means, see, relevant financial information should be capable of making a difference in your decision. If it is not making any difference in your decision, whether you have that information or not, it is not relevant. Relevant means with that information, your decision will change if you include that decision, information. Okay, it is up to the user whether they want to ignore that or they are aware of that information from some other source. But still, if that information has the capable of making difference in the opinion of the user, it's a relevant information. So financial information can make a difference if it helps users to evaluate past, present, or future event known as predictive value, or confirm or correct their past evaluation known as confirmatory value. If it has a predictive value and if it has a confirmative value, it's a relevant information. Predictive value means that information will help you to evaluate your past, present, and future, and you can actually predict through that information. Confirmative means whatever has happened in the past, it is confirming. That information confirms that. Okay, so predictive and confirmatory, they are interrelated. Same information may confirm a previous prediction and be used for future prediction. So confirmative, predictive. Relevance is also affected by materiality. And remember, materiality is entity specific and it is based on the nature. Entity specific means what is material for one entity might not be material for another entity based on the nature of that business. Okay, so for example, transport. If you are in a transport company, your transport is of a material asset to you. But for some company who is in the service industry or who is not related to the transport industry, for them their transport is not a material asset for them because the nature of their business is different, so materiality changed. You see, it's entity specific. So disclosure of earnings per share or magnitude. Next, a uniform quantitative threshold for materiality cannot be specified because it depends on the entity and particular circumstances. Therefore, there is no uniform quantitative threshold that says that if you are beyond this limit, you are material. No, because every entity is different. So materiality in short means, this is the definition of materiality. An information, if you omit or if you misstate the information, it can influence the decision of the primary user. Okay, that is the meaning of materiality. Of course, you will not be asked this definition in your exam, but knowing it will help you in your exam to identify if you are given a set of information whether it's material or not. Next, faithful representation. Financial information that must represent faithfully what it which it purports to represent or could be reasonably expected to represent. So to faithfully represent the economic phenomena may mean that financial statements must do more than mere comply with standards. So just rather than just complying with standard, you have to do more than that. Okay, a transaction or event that is outside the scope of all the standard, still you have to recognize or disclose in your financial statements. Why? See, yes, based on the definition of your standard, it might be outside the scope, but it might be material or it could affect the future uh, continuity of your organization. You still have to recognize and disclose in your notes. Somewhere you have to make a note of it in the financial statements. That is the meaning of faithful representation rather than simply ignoring it. So faithful representation must do three things. Neutral information that you are giving has to be free from any bias. It is neutral. You are exercising prudence. You are not giving weight to any one side. Okay, not this side, not that side. You're not overstating anything or understating anything. That is the meaning of neutral. Next, complete. When you're giving the information, it is complete. You're not omitting anything or you're not giving any false or misleading information. And also, when you're complete means it has to be within the bounds of materiality and cost. That means it has to be material and it should be beneficial also. If the cost of giving them is more than your benefit of that information, you should not provide it. And if it's not material, no use of providing it. So it has to be within the bounds of materiality and cost. And free from error. Okay, what does it mean? See, you cannot expect perfection. Okay, why? Because we have some accounting estimates. That does not mean free from error, does not mean you will not have any error. But when you are giving an information, make sure that you are doing your due diligence. You are doing so that quality of the information is there. You from your side is not negligent, or you are not carelessly doing any error. Okay, so when you are reporting the information, while you are selecting what information has to be reported, while you're applying your judgment, there should be no error in that process. But of course, yes, your financial statements will be with some error. You cannot be perfectly accurate because accounting estimates are there. But that accounting estimates you have to do with due diligence. So remember, whenever faithful representation comes, these three things has to be there. Is your information neutral? Is your information complete? Is your information free from error? Neutral, complete, free from error. Now moving to prudence. We have mentioned the word prudence. For neutral, you have to exercise prudence. What does prudence mean? Exercising of caution. You are being careful when you are making estimates, especially under the condition of uncertainty, when you are not very sure. For example, when you are recognizing asset and income, make sure do not overstate your assets and income and do not understate your liabilities and expenses. Often people do that. They try to show their assets income more, and they try to show liabilities and expenses less, so that it shows that your organization is more profitable, whereas actually it is not. So that's why we, what do? We do the opposite. While stating assets and income, we try not to overstate it, and while showing liability and expenses, we try not to understate it. This is known as prudence. So prudence, if you see, it is evident in various requirements of your existing IFRS. In many IFRS standard, you will see prudent concept has been applied. For example, under your IFRS 9, we have not gone through in detail in IFRS 9, but IFRS 9 is about your financial instruments. Financial instruments means financial assets and financial liability. Financial means anything that has to do with cash, finance. Of course, the detail of IFRS 9 will go when I go through IFRS 9. We are not going through detailed here right now. What we wanted to show is how prudence concept is applied in IFRS 9. So when we are recognizing the credit losses in respect of the financial asset, we are being prudent. We are not showing understatement of credit losses. Okay, we don't have to know how credit losses are recognized in the financial statements right now at this stage. That you will eventually know when you move to IFRS 9. Next, under IS 36. IS 36 is your impairment. So when you are testing your assets for impairment and the resulting losses that you have to recognize, you are again being cautioned that you are not writing too less. And under IS2, inventory. When you're measuring inventory, it has to be lower of cost and net realizable value. And provision, IS 37. When you're recognizing provision, so provisions are recognized for liabilities even if you're not certain of that liability, because we do not want to understate liability. So here also prudence concept is applied. Next, substance. One more word about faithful representation you have to know is substance. So what is the meaning of substance? Faithful representation also means you are presenting the substance rather than its legal form. That means the commercial effect. So in most circumstances, substance and legal form are not the same. If they are same, there is no issue. You can record as it is. But if they are not same, okay, and information, if you are just giving the information about the legal form only, it will not give you faithful represent information. You have to give the information about the substance. Now, moving on from fundamental to enhancing characteristics. So, enhancing characteristics improves the usefulness, comparability. Users has to be able to compare financial statements of entity through time known as internal comparability so that they can identify trends in the financial position and performance and external comparability with different entities to evaluate their relative financial position, performance and changes in the financial position compared to other entities. Next, comparability requires, see, if you have to compare among entities or different time periods, make sure that you are having consistent, you have to be consistent in everything, your measurement, your classification, your presentation of the financial effect. For example, when you are measuring your asset, liability, income, expense, equity, or you are classifying them into current, non-current, or when you are presenting them, there should be consistency. You can't present a current asset under non-current asset next year. Okay, like that. So consistent measurement means applying the same measurement basis. We are going by historical cost, make sure next year also it is historical cost. Unless, of course, the standard requires you to change. So if you are measuring a similar asset in the initial and the subsequent measurement, make sure from year to year you are doing consistent measurement. An application of comparability. Sorry, an implication of comparability is that users must be informed. When you're changing the accounting policies, users have to be informed. And any changes in those policies and also the effect of such changes. What is the effect of such changes? So this will be explained in your IAS 8. Okay, in your lecture 4. So this is an explicit requirement of IFRS standard. IFRS standard says you have to, if you are changing the accounting policy, you have to inform the user. It's a requirement of IFRS standard under IAS 8. Another implication is that financial statements must show corresponding information for preceding periods. This is for comparability. Now moving on to verifiability. Verifiability means a knowledgeable, independent observers could reach a conclusion based on the fundamental quality of faithfulness. Verification may be direct through physical inspection or indirect using model, formula or techniques. Verifiability relates not only to single point estimates but also to range of outcomes and related probabilities. Next is timeliness. Information has to be available to users within a time. Older information is less useful, but still they may be useful in identifying and assessing the trend. Understandability. Financial information should be made understandable through clear and concise classification and presentation. Users are assumed to have a reasonable knowledge of business and economic activities and accounting, and a willingness to study information with reasonable diligence. They are expected to have a level of financial expertise. See, when you're writing a report, you're not writing all the financial jargons and everything. You are keeping it as simple as possible, using simple language, assuming your users knows the terms, they have a sufficient amount of financial expertise. For example, when you're writing, drawing up statement of financial position, now the one who's reading it should be able to know what is statement of financial position is, what does it measure, what does it show, how assets are classified. So you're not going to write description there. This is how it is assumed that all the users, whether it is lender, creditor, customer, supplier, they know that this assets are current. What does it mean? What are their functions? Why they are classified under current? Things like that. Now, information about complex matters, they should not be excluded just because it is difficult for users to understand. You have to include them. Next is the cost constraint. The cost of providing information should not be more than the benefit. Okay. So the cost is initially borne by the reporting entity, whoever is preparing the financial information. And ultimately, first time, initially, it is borne by reporting entity, but ultimately, finally, it will be borne by the user through lower returns on their investment. Users also incur this cost because they have to analyze, they have to take their time and interpret the information. Benefits are difficult to quantify. Okay, so the benefits are you are going to have the better the quality of information, better your decision making. Okay, and you are going to have confidence in the efficiency of capital market, which will lower your cost of capital. Now we have moved on to the important part of the lecture, that is elements of the financial statement. So here onwards everything will be very important from the perspective of your exam and also your understanding of your IFRS standard. That is the terms. First, financial statement element. Financial statement elements. They are the broad classes of the financial effect of the transaction. They are grouped together based on their economic characteristics. If they are similar characteristics, they are grouped together. First item, asset. What is an asset? I've highlighted in bold. This terms has to be there. This is the definition of the conceptual framework's definition of asset. And if you see your IFRS standard for asset, for example, tangible asset, if you take your property, plant and equipment IS 16, or your intangible asset IS 38, or your financial asset IFRS 9, they all follow the same definition, that an asset is a present economic resource that is controlled by the entity as a result of past event. That means in the past there was a transaction. Due to that, now you're owning the asset. This is the meaning of asset. That's why you're recognizing the asset. If it does not meet the definition of an asset, you can't recognize them in the financial statement. It is as simple as that. Next is economic resource. What is that economic resource in the definition of asset? Economic resource means it's a right. You have the right to receive the economic benefit by having that asset. For example, if you are getting any income by owning an asset, let's say you are having an asset, investment, property. Having that, you are going to get the benefit. You are getting rental income. That is the economic benefit you are getting, and you have the right to receive it. So you are recognizing it as an asset, investment property under IS 40. Liability. Liability is a present obligation to transfer an economic resource as a result of past events. Same. Here you are giving up on the benefit. You are passing it. You are not having the right, you are not receiving the benefit, rather you are paying. You have an obligation. For example, if you are taking a loan or if you are taking goods on credit from your supplier, you have an obligation to pay back to your supplier or to your bank. So that's a present obligation that resulted on the past event. What was the past event? You have taken a loan or you have taken a credit. That was the past event. Now, today, present, you have an obligation. That is liability. Next, equity. Equity is after you deduct all your liabilities from your asset. What is left over is known as equity, also known as residual interest. Then, income. Income will increase your asset or decrease your liability. That will increase your equity. But other than those relating to contributions from holders of equity claims, what do you mean? If the founder, okay, let's say the shareholders are contributing anything or they are withdrawing, let's say they are taking dividends, they are having drawings, they are not taken as income. If they are putting anything, they are injecting any money into the company, that is not taken as income. That is dealt separately under equity section. Okay, so income is those things which increases your asset or reduce your liability and will increase your equity. Anything that increases asset will increase equity also. Asset increase, liability reduce, equity. Expense on the other hand is the opposite. It will decrease your asset, it will increase your liability, and it will decrease your equity. Other than those relating to distribution, anything you distribute to the holders of equity claims. For example, you are giving dividends to equity holders. They are not your expense. That dividend is not your expense. Okay, next. An asset. Let us understand asset. Asset can still exist if you are having a low likelihood of economic benefits. Low likelihood is a probability, but it does not mean it will be recognized. See, asset can still exist. In practical world, asset can still exist if there is a low likelihood of economic benefit, but it does not mean it will be recognized. But if it is recognized, then that measurement of the probability you have to find out. Okay. For liability, on the other hand, there is no probability criterion. For probability, whether there's a low likelihood of your obligation to pay or not, you have to recognize. But asset, so which concept are we applying here? Prudence concept. Because we do not want to overstate asset and understate liability. So irrespective of probability, we'll recognize liability, but asset, you can only recognize when the probability is high. And if the probability is low, you have to measure that. Okay. Simply, there has to be a potential for a transfer. You have to have something. And there should be a potential that there's going to be a transfer that is taking place. A low likelihood of transfer. If there's a low likelihood, it can affect your recognition and measurement of that liability. So definition of an asset and a liability, as I told you earlier, they have not been revised in all your IFRS standards because conceptual framework definition has been revised. If you look at the earlier conceptual framework 2015 and 2018, you will see definition of asset and liability has been revised, changed, updated. But good thing is you don't have to go back and study conceptual framework 2015, not required. Whatever is in this lecture, knowing the definition of asset, liability, income, expense, equity is enough for you. Okay. But the problem is some IFRS are based on the earlier definition of conceptual framework, that was conceptual framework 2015, which is no longer relevant, but IFRS standard did not change. They are still keeping on recognizing that asset or liability. Two such standards are IS 38 intangible asset and IS 37 provision. Here they are including a probability criteria for recognition. That means there should be a probability to recognize. Earlier in the earlier conceptual framework definition of asset and liability, they included the word probability. Now no longer is there, but still IS 38 and 37 goes on the term probability to recognize their asset or liability, because provision is liability and IS 38 intangible asset is asset. Okay, so let's go through one example. An entity is purchasing a good on credit. Okay, what happens? Liability is created. So there is a present obligation that you have to pay cash to the supplier. And what was the past event? You have purchased the good. So present obligation met, past event met. So the definition of asset has been met. Sorry, a liability is created. Now the goods, that good that you are purchasing on credit, it is meeting the definition of an asset. How? You are controlling the goods. And past event you have purchased that good. So the goods are then sold for cash. Now you will recognize an expense. Why? Inventory reduced. Cost of sale as an expense is recognized as there has been a decrease in inventory asset, because now you are selling the goods, your inventory will reduce, you will recognize cost of sale. Cost of sale is an expense. From your revenue, from your sale, you will deduct it and find your gross profit. And income, you will recognize an income, because when you are selling, you are receiving cash. Okay, so income you are receiving in the form of revenue when you are selling goods, and you are receiving an asset, that is cash. Your asset increased because now you are receiving cash. So it is affecting three places: expense, cost of sale, income, your revenue, and asset, that your cash. Of course, you don't have to memorize this definition, these examples. They will not ask you for any example in the question, but knowing it just to understand how it works. Now we are moving on to the recognition and the derecognition. What is the meaning of recognition? Recognition means you are capturing, you are including an item, the element in your statement of financial position or in your profit and loss account when it meets the definition of an element. First stage, it has to meet the definition of the 5 elements. It has to be an asset, income, expense, equity, or liability. If it does not meet the definition of that element, no need of recognition. Forget about it. But if it meets the definition of an element, then you come to the second question: should we recognize it? So the recognition involves the depiction of the item in the words and by a monetary amount, the money measurement concept. It has to be there should be a money involved for you to recognize. Either money has to come, either money has to go. And the inclusion of that amount in one or more totals in that statement. So it will go in these three statements, either in the cash flow, either in the profit and loss, either in the statement of financial position. Okay. Now, only items that means the definition of an element may be recognized. However, remember, not all items that do meet these definitions are recognized. Sometimes it might meet the definition, but still it is not recognized. It happens that also. But remember, inappropriate recognition can never be rectified by disclosure of the accounting policies or notes. For example, if you are recognizing something inappropriately, later you can't justify by saying that you have disclosed it as a note. You can't do that. Never. Now, the recognition criteria. Recognition criteria is an asset or liability is recognized only if recognizing provides useful information. Useful information means what? By giving information, that means it has to be relevant and faithful representation. Of course, with income and expenses, any resulting income, expense, or changes in equity. Recognition may not always provide relevant information. For example, if you are uncertain whether an asset or liability exists, there is an existence uncertainty, or it exists but the probability is low. The probability of economic benefit is low. So in this case, even if you recognize it, it's not a relevant information because probability is low and also uncertainty is high. Now, derecognition. Derecognition means you are removing either all or part of that recognized asset or liability from the statement of financial position. Where do you record asset and liability? Statement of financial position. So from there we'll derecognize. We just reverse it. Earlier we recognized, now we'll simply take it away from there. So it normally occurs when the definition of an asset or liability, they are not meeting the definition of an asset or a liability anymore. Okay. So when entity loses the control of an asset, it will not meet the definition of an asset. When they do not have any present obligation for the liability, it does not meet the definition of liability, hence derecognized. Now, measurement basis. Conceptual framework refers to two measurement bases, historical cost and current value. First, we'll go through historical cost. Historical cost is based on your transaction price when you have first acquired the asset or liability. Okay. This measurement basis does not take into account the changes in the values. Current value, on the other hand, reflect the changes in the value. Conceptual framework gives you three current value measurement. You can measure your current value using three measurements. Conceptual framework defines this. First, fair value, for which we have a standard IFRS 13, which we are going to cover in this lecture. So fair value means any price in a transaction, orderly transaction between market participants. Normally, when you go to the market and when you want to know the price, let's say of your phone, that is a fair value. You are going to get a fair value. Why? Because in the open market, you can get the fair value of your mobile phone easily because that mobile phone is sold in a huge quantity. There's a huge volume frequency of that product going on. So it's easy for you to get a value. That is fair value. Why? Because there is an orderly transaction. That transaction is not unique to you. Anyone goes, they will get the same price only. And it is done between the market participants, buyers and the seller in an open market. Next, current value measurement is value in use, or also known as fulfillment value. You need this, by the way. This value in use, you mostly need it in your impairment. IS 36 later on you need it. So make sure that you know the definition of this right here itself. You understand. Value in use is your present value of a future cash flow that you're expecting to derive by using that asset and its ultimate disposal. So you are going to compare whether it is better to hold the asset or sell the asset. When you want to hold the asset, you want to calculate its value in use. How? By finding the present value of cash flow by holding that asset. That is known as value in use because you are using the asset, hence the term value in use. Fulfillment value is the present value of resources that are transferred to fulfill a liability. Fulfillment value is for the liability. Value in use is for the asset. So these are entity specific values. Remember, value in use is not a market value. For every entity, this value in use will be different because they are estimating. This is an estimation. Third, current cost. The next way you can have the current value measurement is through current cost. Find the cost of an equivalent asset or consideration that you would receive for an equivalent liability at the measurement date, at one measurement date. When you go at different dates, the cost might be different. Current cost is an entry value. So it reflects the price in the market in which the entity would acquire the asset or incur the liability. In contrast to the fair value and value in use, they both are exit values. Okay. Although most IFRS apply the historical cost measurement basis, some combine this with other remeasurement basis. For example, for investment property and property, plant and equipment, there are fair values. Okay, you can remeasure your asset to fair value from the historical cost. Next, historical cost accounting. So the two accounting bases. First is historical cost accounting. Traditionally, every company used historical cost accounting. This is based on what you paid for an asset when you originally bought it, hence historical cost. But now, since the economies have advanced, there is a concern that historical cost accounting will not reflect the modern economies of today's transaction. Now, let's go through some advantages and disadvantages of historical cost. First advantage is very easy to understand and it does not follow any change. Okay. Next, amounts are reliable because you can check the evidence by a purchase transaction and also you can verify them to an invoice or payment. Third, objective amounts are difficult to manipulate, which reduces the possibility of creative accounting. Then, conservative measures that prevent overvaluation. It is widely used throughout the world. Disadvantages are it's a mismatch in the reporting period, as current revenues are matched with out-of-date historical cost, that is cost of goods sold and depreciation, and the revenue they are not matching. Okay. Next, your value of assets in the statement of financial position does not equal to the economic benefit to be earned from their use. Third disadvantage, historical cost ignore inflation. Okay, because higher the price inflation, greater would be the overstatement of profit. Disadvantages, holding gains are not separated from operating gains. What is holding gain and operating gain? We'll understand this with a small example. Holding gains are gains that are made by holding onto an asset. Okay. So example 2, if you have bought an item a year ago for $10 and today you want to sell it for 18, but you want to replace, okay, but to replace it would cost $15. What is the profit? You bought it for 10, you are selling it for 18, profit is 8, but this 8 profit is made up of two elements, components. First component, it's a holding gain. What is a holding gain? Cost, the cost of replacement is 15 and you have bought it for 10. So the difference between what you have bought versus the replacement cost is known as holding gain. And the balance 3 is operating gain. That is what you have sold 18 and the amount that how much it would replace, how much it would cost to replace. You will compare with that with the sale proceed. 18 minus 15 hence 3. Now, so is the current value the answer? The accounting profession has attempted to introduce some form of current value accounting model. For example, in 1980s, UK GAAP was required by listed company to provide supplementary current cost information in their financial statements. Now, advantages. Current value gives information that is more relevant to the users of financial statements, especially for companies with the older asset base. Next, in times of inflation, current values of assets and liabilities will likely to be much higher than their recorded amounts. It takes inflation into account. You see, historical cost did not take inflation into account. So the limitations of historical cost are solved by the advantages of current value accounting. But on the other hand, it has more disadvantages. First, there is no one current value. Second, getting the information is difficult because Current values, some current values are easily obtained. For example, replacement cost of inventory. Okay, but to calculate value in use, they are very subjective and therefore less reliable. Valuations, it is difficult to impossible to verify, and comparisons between companies could be made even more difficult. Next, majority of users do not understand what the figures represent. Now, what is the IFRS stance on this? Currently, under IFRS, there is no formal model of current cost accounting. However, several standards you will see requires assets and liabilities to be measured at fair value. One example is financial instruments under IFRS 9. Okay, and some standards gives you a choice. Some it is compulsory fair value, and some do not go by fair value, they go by the cost accounting. We'll see this in detail when we go through various IFRS standards. So that time you have to remember this fair value concept. Now, current value accounting seeks to provide more relevant financial information than your historical cost. But even though it gives more information, it brings up new problems and issues that are even greater than those under historical cost accounting. Next, so this led us to a new standard known as IFRS 13 fair value measurement. In this standard, you will know how to measure the fair value. So IFRS 13 does not specify when an entity should use fair value, but how it is used, the standard will say. For example, IS 40, that is investment property. It allows your investment property to be valued using fair value measurement. But even though it allows fair value measurement, it is only IFRS 13 which specifies how it will be measured, how that fair value is measured. IS 40 will not tell you how fair value is measured. Not even IS 16, not even IFRS 9. If most of the standard you will see, they will say fair value, fair value, fair value. Option is there, cost versus fair value. But how that fair value is measured is in this standard, IFRS 13, not in that IS 40. So fair value, this is the definition. Price that would be received, price that you are going to get by selling an asset, or pay to transfer a liability in an orderly transaction between market participants at a measurement date. At one date, you are transferring normal transaction among the market participants, and buyer is there, seller is there. So price that you would receive by selling that asset is your fair value. Okay. So when you're measuring the fair value, all the characteristics of an asset or a liability that market participants would take into account would be reflected in that valuation. So this could include the condition or the location of the asset and any restrictions on its use. Of course, when an asset is not in a good condition, fair value will be lesser. That is the meaning of this point. That whatever the current condition or location of an asset, or if an asset has any restrictions on its use, that condition will be reflected in the price of the fair value. Definition is market based. This fair value measurement is not entity. It will not change from entity to entity. It is market based for everyone. This is the same definition. So it reflects factors that market participants would apply to the asset or liability, not the factors that entity would necessarily apply. So definition, some definition you have to know under fair value. Very important. Fair value looks at the active market. What is the price in the active market? What is the meaning of active market? A price in which transactions for asset or liability takes place with sufficient frequency and volume to give a information on an ongoing basis. So to get a price, there should be a huge market, frequency has to be high, volume has to be high. There should be an asset which is very frequently traded and volume is huge. That is known as active market. So you can easily get the price. Next, highest and the best use. This term will use for non-financial asset. So to get a fair value of a non-financial asset, we have to go by the highest and the best use. So the use of a non-financial asset by the market participants that would maximize the value of the asset or the group of assets and liabilities. Example, a business within which the asset would be used. Principal market, the market with the greatest volume and the level of activity for the asset or the liability. And most advantageous market, market that maximizes your fair value of an asset or minimizes fair value of a liability after taking transaction and transport cost into account. I repeat, after transaction and transport cost. These terms you have to remember. You always have to deal with them when you're dealing with fair value. Active market, highest and best use, principal market, most advantageous market. Without this, you can't calculate fair value. You will understand later when we do questions to find fair value why. Then we are moving on to non-financial asset. So, for example, investment property is a non-financial asset. How do you do fair value measurement for that? Based on the highest and the best use. So, highest and the best use takes into account the following. First, use which is physically possible, with what is legally allowed and financially feasible. So, you should be able to physically use it. It has to be legally allowed. You have to be given the legal permission, and financial feasibility has to be there of using that asset. It has to be advantageous. Otherwise, what's the use? If this three things is there, so the highest and the best use does not reflect illegal activities. Remember, but does reflect what is economically viable, considering any financial constraints. Highest and the best use of an asset may be in combination with other assets or other assets and liabilities that would be available to market participants. If an entity uses a stand-alone asset, but its best use would be in combination with other assets. See, sometimes you can use an asset individually, like independently you will be able to use the asset, but sometimes to make it better use of that asset, you can combine the use of that asset with some other assets. So that is known as best use. So fair value will be based on that best use then, not that value of that independent asset, irrespective of its current use. Currently it can be used for any purpose, but the fair value when you're taking, you look at the best use, whether it is used better as a standalone or as a combination with another asset. One example is land. Land can be used for commercial, land could be used for residential. Okay, but in the case study you will be given what is the best use. Okay, they will give you an amount and all. Price. IFRS 13 assumes transactions will occur in the principal market. Okay, remember the definition of principal market for the asset if one exists. See, not all the assets have a principal market. If there is no principal market, valuation will be based on the most advantageous market. First priority is principal market. If principal market is not given to you, advantageous market. One of the two will be given. Okay, it can't be that none of them is given. Unless proved, the market in which the entity normally transacts is presumed to be the principal market. See, normally in the market where you do the transaction, that is your principal market. Next, price is not adjusted for transaction cost. You are not adjusting your price for transaction cost. But what about transport cost? For transport cost, you are adjusting your price. Okay. If a location is a characteristic of an asset, then the price will be adjusted for any cost that are incurred to transport that asset from its current location to the principal or most advantageous market. Now, there are three valuation techniques that are used to estimate the fair value. Okay, this is a very popular, what do I say, examiner's question. Okay, in your exam, you might be often asked questions on this. The three levels, the three hierarchy that are used to value the fair value. Okay, level 1, level 2, level 3. But right now we are going through the various approach to estimate fair value. First is market approach. Under market approach, we use the market. Okay, so we use the price and other relevant information that is generated by the market. So we see whether we have any identical or comparable similar assets or liabilities. We compare like with like. If identical, if not identical, then similar. Next is cost approach. Here we see the amount that will be required to replace the service or capacity of the asset. So for example, current replacement cost. Third, income approach. We convert the future cash flow or income and expense to a single current discounted amount. Models which follow an income approach is your present value. The best approach out of this three is market approach, and the least one is income approach. Why? Income approach, you have to estimate a lot. It has more uncertainty. But market approach, prices are freely available. So it's more objective. You can verify, you can confirm. So the hierarchy of inputs, as I told you. Inputs are categorized into three levels. Level 1, level 2, level 3. Level 1 is the highest. Level 3 is the lowest priority. Okay. So this valuation techniques require the use of the input that you are taking. Okay. An income approach. Okay. Out of the three approaches, the income approach will require you to estimate your cash flow and interest rate. That is which level? Level 1, level 2 or level 3, level 3. Okay. So now we are going to go through the three levels. Level 1. Level 1 input. Quoted prices. Easily you will get. Active market is also there. So quoted prices in an active market for identical assets or liabilities. Identical assets or liabilities also you will get. Which entity can access at the measurement date. This input is the most reliable evidence of fair value. Here you can just take it without any adjustment. For example, if you want to get the quoted market price of your shares, you can easily get it in the stock exchange. Okay, quoted prices of government bonds actively traded, you can get it. Next is level 2. Here we observe observable inputs are not quoted, but we observe from the asset or liability either directly or indirectly. This includes similar, if not identical, then similar. It is not their best but better than level 3. Okay, here you have to adjust because it is similar. Similar means some differences are there. So you have to adjust to reflect the factors that are specific to that measured asset or liability. For example, if you're having a fair value of a fixed income security without an active market, and if you're using it as a benchmark for similar securities with observable prices, you have to adjust. Okay, fair value of a security that is not actively traded. So anything that is not actively traded, most of the time you have to adjust. Okay, maybe a broker's quote based on some observable market data for similar instruments. And third, fair value of a building in use may be based on a price per square meter for comparable buildings in similar location. It is hard for to get the same identical building. Okay, here and there you have to adjust the fair value of the building. Now level 3 is the most riskiest out of 3. You have to try to avoid as much as you can. If you can't, then we go by level 3. Unobservable inputs, where you can observe the inputs for the asset or liability. So this is inputs are relevant when there is minimal or no market activity for a particular asset on the measurement date. For example, if you want to get the fair value of a decommissioning liability assumed in a business combination, it's hard. For an internally generated intangible assets or goodwill that is unique to you, there is no similar market, no active market, very difficult. So here you have to use your entity's assumptions when you want to price the asset or liability. This involves a higher degree of subjectivity and you have to rely on your own data or models to estimate your future cash flow for a cash generating unit. The techniques used to estimate fair values should maximize observable inputs wherever possible. So the hierarchy, that is the order of inputs, aims to increase the consistency of usage and comparability in measuring fair values and their related disclosure. Now, final part of this lecture and also IFRS 13, that is disclosure regarding fair value. So the disclosure requirements of IFRS 13 are extensive and it depends on whether you are in level 1, 2 or 3 you have used for your measurement techniques. Disclosures are both quantitative and qualitative. Standard also distinguishes between measurement of a recurring nature or those of non-recurring. Now, the disclosures listed here are only a selection of those required, as the exam will not test your extensive knowledge in this area. Okay, so these are the disclosures and only based on this only you will be tested. Nothing outside this. That is, why are you using fair value? Then the level of hierarchy that you have used. Then you have to use the description of techniques that you have used in level 2 or 3. For one, it's not needed because you are using the same price. For non-financial asset, you have to disclose. Okay, if you are using the highest and the best use differs from what the entity is using. And for level 3 input, you have to reconcile your opening and closing balances and any amount that is included in profit and loss for the period. So that's it for this lecture. From the syllabus, we are still under section A, that is conceptual and regulatory framework. We have covered first part in section A, that is the need for conceptual framework. Here we have described what is conceptual framework. We have discussed why it is necessary. We have discussed relevance and faithful representation. And we have gone through the 4 enhancing characteristics: understandability, verifiability, comparability and timeliness. Then in section 2, we have gone through recognition and measurement. We have identified what is meant by recognition and discussed the recognition criteria of all the 5 elements in the financial statement. Then we applied the recognition criteria to assess liabilities, income, expense, and we have explained the following measures using historical cost, current cost, value in use, and fair value. For fair value, we have a standard also. Then we have discussed the advantages, disadvantages of historical cost, current value, and under regulatory framework, we have discussed principle-based versus rule-based framework. Then, now let us summarize the lecture. So we have started with the objective of the general purpose financial statement is to provide information to the user, primary user, in making decisions. Next, financial statements are based on underlying assumption that entities are going concern. The 2 fundamental characteristics are relevance and faithful representation. Faithful representation means neutral, free from error, and complete. 4 enhancing characteristics are comparability, verifiability, timeliness, understandability. Then the elements of the financial statements, the 5 elements: assets, liabilities, equity, income, and expense. Recognition is the process of capturing for inclusion in your statement of financial position, statement of financial performance, or statement of cash flow once it meets the definition of an element. Measurement involves assigning a monetary amount. So those are the bases: historical cost, okay, and current value. So in the current value, we have current cost, value in use for assets, fulfillment for liabilities, and fair value. Then IFRS 13 prescribes the techniques for measuring fair value. It does not state when to use a fair value. That is up to you. Level 1 should always be maximized compared to level 3 inputs. And there is no technical article as of now for this topic, that is conceptual framework. Thank you for watching, and I shall see you in lecture 3. Lecture 3 is again a very new topic because there has been a change in your syllabus. That is IFRS 18 has replaced IS 1. So IFRS 18 will be discussed in lecture 3. Meanwhile, do not forget to subscribe to my channel if you haven't subscribed, and do watch my other previous lectures under the FR lecture playlist. Thank you.